Hi, welcome to the third series of Elite Realty's Health and Financial Management classes tonight. I'm Christine Jacobson, Managing Principal Broker of Elite Realty. Tonight we have Gladys Boutwell here. She is a licensed broker and represents PBP Insurance Company with health, life, property, casualty, and is licensed in Oregon and in Washington. She's also one of Amazon's #1 best-selling authors for her book, Health and Insurance Secrets Revealed. She has been a featured guest on many radio shows, and I met Gladys last week when she came in to talk to me about a benefits package for the brokers here at Elite Realty, and I found her very informative, very professional. I really enjoyed the information she shared with me, so we've invited her in here tonight to talk to us about how to use your life insurance benefits as a retirement package. So Gladys, please join us.
What does life insurance and your spouse have in common? They're expensive, they're difficult to understand, and you never know what you ultimately are going to get. I'm Gladys Boutwell. I'm an insurance broker with Pacific Benefit Planners. Today we're going to be reviewing how you can use your life insurance for your retirement. That's a great thing to do. Now, one thing to keep in mind is that what I'm saying here may not be the best thing for you. It is important that you talk to your financial advisor to see what is going to be the best thing for you to use for your retirement. There's many vehicles out there. This is just one of them, and it could be that it would be one thing that would be great with what you're already doing. So today we're going to review why have life insurance, the different types of life insurance, and how they can be used for retirement. Does that sound good? Yep. All right, perfect. All right, so first of all, there's the keys to buying life insurance. One of the first questions you need to ask yourself is, what is the purpose to buy life insurance? You have to ask yourself, why do I need life insurance? And really the very first thing is, do you have somebody that is financially attached to you? Your child, a spouse, maybe even a parent. And if you can answer that, then you can say, okay, I do have somebody that needs me financially, and if I'm not here, how can I provide for them? The other is, if I don't have somebody, then how else can I utilize my life insurance? Second question is, how much is the right coverage for you? Because you might say, well, how much do I need? Some of the things to look at is, it's not only about your income, but it's your income for X number of years. It's the income to pay for the child's education. If you have somebody that's disabled, that's more income. So you have to have the right amount. And I have a spreadsheet that I can provide to you so that you can utilize that towards figuring out what is the right amount for you. The third question is, what is the right type of life insurance? Each person is a little different. Somebody that has a 1-year-old child is going to be very different use than somebody who has no children, is married or not married. That can make a difference. And so that's going to be very important, is what type of insurance is going to be the best fit for you. Now we're going to go through some of the life insurance, and there are two different types of life insurance. One is permanent and one is term. First we're going to go through term life insurance here, or the different types. So term life insurance is essentially a death benefit. That means that somebody is going to be your beneficiary. If you pass away, they're going to get an X amount of money. That policy is going to be based on the number of years that you've chosen. You say, I want a policy for the next 10 years because I have a 10-year-old, and for the next 10 years, if something happens to me before they go to college, I want to make sure that they're financially okay. If they're 1-year-old, it might be different. You might say, you know what, I want a 20-year term policy. Or maybe you're 60 years old and you say, you know what, I still want some policy that I can leave my children or my spouse. So let's look at that and the amount that's right for you. And now there's whole life insurance I went to. Both the whole and universal life are guaranteed death benefit for the life of the policy. as well as being able to borrow against it. Both of these are more expensive than term life insurance. Term life insurance is the most affordable of all the life insurance. But here you're going to be able to see how these other insurance policies can also be used towards your retirement. Now, variable, that one is, there's a lot of control with those investments. However, because it is attached to the stock market, you need to have a securities licensed agent for that type of policy. So that one, I'm not going to go into detail on that at all because I'm not securities licensed. But if you do want to talk to your advisor on that and they are securities licensed, that would be another policy to look at. And then you have your index universal life. Again, this particular one is similar to your whole life and your universal life. They're going to have a death benefit. They're also going to build cash value. This one will provide you with the minimum interest guaranteed. And it's also, you can fund it. Any of these you can choose to fund for a certain amount of time, but each one is very specific. So as you're looking at them, you have to say, okay, what can they do, and look at each one, because one may give you a better benefit for your needs than another one. Now here's a term policy. It's for a 54-year-old female, $100,000 policy. Now here you can choose, or she can choose, does she want a 10-year, a 15-year, a 20, or a 30-year? So let's say here we look at the 30-year. And then we go across and we say, okay, is she a tobacco user or a non-tobacco user? If she is a tobacco user, right here, the system will not allow her to get a 30-year, because if she's 54, the insurance company is saying she might not make it to 84 because she's a tobacco user. And so she can only get a 30-year term policy if she is a non-smoker. And based on her health, it'll determine what she would be paying. Here, if we do $68.90 per month or $783 per year, this is a death benefit only. If she passes away between the age of 54 and she's chosen 30 years until the age of 84, her heirs or her beneficiary will receive $100,000. This is the most basic one of all the policies. Next is your whole life policy. In this case, it's a 39-year-old non-smoking female. Here, she's giving $400 a month or $4,800 per year for 20 years. Depending on who you're going through, they may allow you to pay for less, some of them, or for less years. Some of them might say you have to pay for more years. In this case, this particular one says you have to at least invest for 20 years. That's $4,800. These policies are just one page. Most of the illustrations you're going to get are going to have 30, some of them 40 pages long. So keep in mind, this is only a sampling. If you look over here, you're going to see the death benefit. It's going to be incrementally increasing. It starts at $223,354. By the age of 64, it's up to $350,668. The death benefit if the person were to pass away during the life of this policy. Now here, it's a contribution of $96,000 in these 20 years. When we look at using it for retirement, she can start taking out $8,000 a year when she's 66 through the age of 79. By the time she gets to 80, she can only withdraw $7,828. And the reason for that is based on the cash value that this policy has accumulated. When she turns 81, she can only take out $2,790. By 85, it's $3,099. Here I only show it to age 94, $3,831. And if you notice at the death benefit starts incrementally going down because money's being pulled out of this policy. So total withdrawals, if she were, and this is just going through age 94, it actually goes all the way to age 181, it's $162,716 between the ages of 66 and 94. So you put in $96,000, but you're pulling out $162,000. Money towards your retirement. And if you were to pass away, your beneficiaries will be receiving money also. right?
Yeah, that makes sense.
Now here's a universal life insurance policy. This one I got the cleanest, the simplest one to read. 39-year-old, non-smoking, female again. $400 contribution per month. So a total contribution of $72,000. This is over 15 years. The withdrawals start at age 65. And if you look at the withdrawals, it's $117,620. So put in $72,000, you're able to withdraw out $117,000 between the ages of 65 and 71. Death benefit, though, if you look compared to your whole life policy, death benefit is $181,684 when you get it. By the time the person is 70, it's $105,000. So the death benefit is a little bit less than your whole life policy. So that's why I say you have to look at all the policies. Which one is the best one? Which one is going to give you a guarantee versus a non-guarantee? And so that's why it's very important that when you're talking to somebody that's helping you through this is looking at all your options and what is going to be best so that you have the money that you want for your retirement. Here's the Index Universal Life. This one, it's again, your non-smoking 39-year-old female, contributions of $72,000, that's $400 a month for 15 years, so from age 39 to 53. Death benefit here, it's going to be moving higher and then lower. So it starts at $160,000, goes up to $255,000, and then starts dropping down once the contributions stop. No more contributions until she's age 65. She starts withdrawing out $28,923. From age 65 till age 74, that's the amount she's withdrawing. Death benefit again, it starts increasing and then it decreases. By the time she's done pulling out the money at 74, she will still have $12,000 left into her account. So if she passes away at the age of 78, her beneficiaries will receive $12,935. Total withdrawals, $289,230. It's about how is it that you are using that life insurance. What type of policy are you using? How old are you? Are you a tobacco user or non-tobacco user? How much money are you putting in order to be able to generate income for when you retire? For some people, this is perfect. For others, it's, I just want a death benefit, wanting to make sure my children are taken care of. I have somebody that came in and said, I need $500,000 in life insurance. And I said, why? And he said, because my divorce lawyer, or my soon-to-be ex-wife's divorce lawyer said I had to have it. I said, for how long? He says, I have no idea. So found out there was a child involved who's 3 years old. Okay, well, these are your options. And he said, well, you know what? I want the 20-year policy because I want to make sure that my child goes all the way through college. Okay. But he just wanted to make sure it was about his daughter, not about the adult, because that's who was most important for him. And that's what we need to look at in these policies is, again, going back to your why. Why do you have life insurance? Because you don't, if you have somebody that is relying on you, you don't want to leave them in a situation where you're almost going bankrupt because they're attached to you financially and you're responsible for them and they have nobody else. Now, there are other uses for life insurance. In the business world, we can use a group life insurance. It's usually not too expensive. It's term policy, so it's nothing complicated. Executive comp, deferred comp. So if you want to keep an employee working for you for 5-10 years, you can say, okay, if you stay for this company during this timeline, then this is what we're going to do for you to compensate you. Or if they hit certain goals, now they're getting some bonuses. As well as buy-sell agreements. Buy-sell agreements are actually, what's the wording in a legal document? That's an actual legal document. We use life insurance to attach to it in order to allow the business to continue. This is for business continuity. It's usually used when the families or the heirs do not want to take over that part of the business, and so they say, okay, they shall sell the shares of this person to the partner, so that the partner now has 100% of the business, and the heirs, the beneficiaries, get the life insurance. So there's various ways that life insurance can be used for retirement. Executives are a great way, use that as a great way to use it towards their retirement portfolio. And the other thing that is great about these benefits that I had not mentioned is that they're tax-free. That means that you put money into it, it grows, not just tax-deferred, they're growing. When you pull out that money for your retirement, it's tax-free. As long as you don't close out the policy, because then it becomes a taxable incident, it's going to be tax-free. Your heirs, when they get that money, that $100,000 or that $200,000, when you pass away, they're not being taxed on that.
Wow, that's nice. That's good to know.
Yes, because when you put money into the stock market, you get, I sold stock and then, oh, capital gains. There are no capital gains in life insurance. It grows, and then when you pull it out, tax-free.
That's fantastic. It's same with the benefits, nice.
Yes.
You know, I haven't talked about that yet, but maybe we'll do that next time then. Awesome.
Absolutely. Any other questions you may have?
Are you required to start drawing money out at a certain age?
No. Really, you can pull out money at any time. And I tell people, yeah, you can, but the purpose is to use it towards your retirement. So if you need to pull it out, you do. It's because if there's cash in the account, and some of them will allow you to borrow off of it. So you can borrow. If you say, I don't want to touch my money, but I want to borrow against it, then you can do that. So you can either borrow.
You don't have to pay it back, though, do you?
If there's enough cash value in there, and that's part of what your advisor will help you with, that is, if you don't pay it back, is there enough money in there to pay it back for you to where it doesn't lapse, which means that it's no longer in force. And if you pass away after it's no longer in force, then now you have no money to give to your beneficiaries. So those are things to look at. How can it be done so that you can do that? And that's a very individual thing. So each person is going to be very different as to how they use it, how they set up the account. And that's why this is very high level. This is samples. It is not exactly, you know, when you look at what will you need, it's going to be very different than what Kristen will need. So those are things to look at. And if you do want to do that, then it's, okay, how do we set it up to where I can do that? So that's a very good question. Any other questions you may have?
Not right now. I think
All right.
that was about it. Thank you.
Thank you very much.
Thank you.
Thanks for having me.
Thank you.